Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally bi-weekly, so generally a every other week review and preview of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. There's just a general disclaimer as well that you need to look at. Our goal as well is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll try and answer those as we go, or at least after the webinar finishes. Okay, it's Wednesday, July 23rd, 11 a.m., just past 11 a.m. in London. So let's get to it. First of all, we'll just have a look at the markets generally, how they're trading this morning. We'll then look at one of the key themes, earnings, as well as addressing actually the Japan situation with the upper house election over the weekend, and then the trade deal announced overnight by Donald Trump. As I say, we'll look at that. Then we'll briefly look at Q2 earnings season, and we'll look at Google and also Alphabet and Tesla, just a bit of a deeper dive into those results expected after the US close this evening, US time, UK time that is. And then we'll just have a brief review of the main event from last week, US CPI data, as well as a bit of UK data, before then looking at the ECB meeting tomorrow, and PMI data are actually out tomorrow as well. We'll also, of course, look at all the corresponding majors, the FX majors. So the DXY, the dollar index, we'll look at GBP against the dollar, we'll look at euro dollar, and also dollar yen shortly when we look at Japan and a few of the stock indices as well. Okay, first up, earnings and just how markets are trading. Generally, as I said, President Trump announced trade deals with the Philippines, Indonesia, and notably Japan overnight. The latter, that involved a $550 billion investment into the US from Japan, 15% tariffs for Japanese goods versus the previous threatened 25%, although we're still waiting for detail about exactly whether that is every import. Japan is also said to be committing to buying US planes, so Boeing, and also rice, and that is really a big turnaround from the Japan's especially prior pushback against rice over the last few weeks that we've seen. Japanese PM Ishiba, he's likely to announce his resignation as early as this month, according to press reports, although other reports as well suggest August month end. That has been denied by him, but really it does usher in a period of political uncertainty in Japan. Questions really over how any new prime minister will work with opposition parties. Will there be more fiscal expansion? Will there be more pressure brought to bear on the Bank of Japan? For example, if he is replaced by someone like Takaichi, she wants the Bank of Japan to go slow with rate hikes, while opposition may push, trying to make political hay really, and may push for tax cuts, which had actually weighed on JGBs prior to the election over the weekend. So a lot going on in Japan at the moment, especially with the deal, of course. That helps the Bank of Japan, of course, who meet next week, but also then potentially this political uncertainty is potentially a headwind for yen especially. That said, the Nikkei has jumped, I think, over 3%. It closed at 3.5%, I think, up on the trade deal news, and US stocks as well. Futures are in the green after mixed performance yesterday from tech, especially underperformance in tech, but futures are in the green. APAC stocks mostly closed higher, and European stocks are positive. Euro Stoxx 50 was up over 1% last time I looked, and that comes after the market closed with losses of 1% actually on Tuesday. Let's just look at dollar yen then first of all. Just showing you a chart here that we can see, as I say, a lot going on with the yen, well, Japan in general, as I've mentioned. So technically, you can just see we didn't get quite up to the halfway point of this year's sell-off. That's at 149.37. The 200-day moving average, that black line, is at 149.56. So just sort of acted as a sort of resistance zone, if you like, and we've just rolled over again. You've got the 50-day moving average, that blue line, that's at 145.14. Then, well, we've just gone through the 38.2 of this decline, that's at 147.13. So note that, and then below that, a minor fib level, 23.6 at 144.36. Okay, that's dollar yen. Let's get to then also moving on to Q2 earnings. We get, of course, market heavyweights, as I've said, Alphabet and Tesla leading the charge this week, later today. So far, Q2 results have started flowing in. In general, we've had positive surprises, which are encouraging so far. I've just got a couple of charts to show you around this. So firstly, on the left-hand side, you can see that positive surprises picking up quite sharply there. Major banks last week, just for your guide, they posted bigger adjusted profit hauls from a year ago, while trading revenues were at record highs on basically geopolitical volatility. Also, most expressed optimism about the investment banking outlook for the rest of the year after deal making rebounded. So yeah, upside surprises really being encouraging. More than a fifth actually, so 104 I think S&P 500 companies report this week. Apart from Google and Tesla, which are of course the first Magnificent Seven mega caps to release, we also get IBM today, Blackstone, Intel, Honeywell tomorrow. And Honeywell is often seen as a proxy actually for the broader industrial economy, so that'll be interesting. All around, of course, tariffs and any tariff impact that we've seen already. Yesterday, GM and RTX, they got hit on basically poor guidance, disappointing guidance going forward, and that was due in part or mainly down to tariffs. So we've seen some impact on some stocks already. I think notably as well, the downside surprises will get punished more than any upside surprise, with expectations now picking up quite sharply. As for the Magnificent Seven, just going back to them, of course, they're now back to outperforming the broader market. You can see that on the right-hand side chart. And that has returned towards performance being highly concentrated then in a handful of names. And we've seen that time and time again over the last few years, and that has returned now since, of course, Liberation Day and that big sell-off. You can just see the red line being the Magnificent Seven, of course, and that darker line on the right-hand side chart being large caps, just X Magnificent Seven. And just that outperformance continues to grow. S&P 500 earnings in general, they're expected to have climbed now 6.5%. I think that was in this quarter, sorry, from a year ago. That is up from below 5%, I think, initially before all results had started. That's according to LSEG IBES data as of last week. It would be the 8th consecutive quarter of growth, but if realized, actually well below Q1, which was near 14% growth. And it would actually be around probably the slowest quarterly growth since the tail end of 2023. As for specific stocks, well, just for your guide, here is some sectors, and you can see that 6.5% positive that should be, so in the green really. Worst sector at the moment, expected energy, and then the best sectors, communication services and tech, of course. Just moving on then to Tesla, first of all, if we just pull up a Tesla chart, just bear with me 1 second. Which is here. Yeah, I mean, it's been a volatile year, of course, for the EV maker. Stock is down around 12% year to date. Sales have slumped, so revenue margins, earnings, all expected to fall sharply with double-digit declines. Analysts, they expect a 42 cents per share in earnings. That's down 23% year on year, and that's on $22.7 billion in sales, with revenue seen tanking more than 11%, all down to, of course, the fading EV market share of Tesla, stronger competition, and then tarnished brand. Lots of EV credit sales in the US have also been a headwind, so really investors pinning hopes on the earnings call with CEO Elon Musk. Updates on probably a few notable areas. Robo-taxis, of course, after the launch in Austin just a few weeks ago. Questions around safety issues there. New product launches like the long-promised Model 2 would be really of interest. The latest on FSD, full self-driving, that will be interesting, as well as AI initiatives, plus, of course, that impact of the loss of EV credits. Any guidance, color around those areas will be key for the stock going forward. Option markets, they price around a 7.5% up or down move after the results on Thursday. So just watch out for that. Technically, you can just see we're just above the blue and the black lines, so the 50-day and the 200-day moving average. That's also in line with the 38.2 fib retracement level of this sell-off, which comes in at 319. So that's kind of a zone of support potentially, although we are trading around it, so haven't conclusively, decisively broken above it yet. So watch out for that. 319, 318 is the 200-day moving average, and 325 the 50-day moving average. Otherwise, upside breakout sees the halfway point potentially, and these highs here from June and May, 351.40, then the high from June, 356, and then the high from late May at 367. Otherwise, then the 61.8, sorry, fib retrace level of this move lower, that's at 383. Otherwise, downside move, if we do break down through that sort of 318, 319 level, let's just put up the next fib level, which would be the 23.6, a minor fib level for sure, but it did cap that downside and some levels here in May and June, so that comes in at 278.98. Okay, that's Tesla. Alphabet, let's pull up the Google chart, which is here. Their earnings, well, they'll be scrutinized even for AI monetization, of course, ad growth and cloud profitability. The company forecast to earn $2.42 per share on revenue that is approaching nearly $80 billion. AI-related capex, the pop, of course, particularly management positions the Gen AI model suite really in competition with its peers. Stock go to these earnings, you can see, with very strong momentum. Options markets, they imply a 5.7% move up or down, that is, so potentially meaningful surprise, of course. Any dip, of course, would trigger a sharp reassessment. But in general, you've got to say it's kind of not just about the beats or misses this week with earnings. They'll be about guidance, about tone and momentum in a market where sentiment is running high, the index is at all-time highs. Then these Mag 7 stocks will be critical, as they are such a weighting in the S&P 500 and of course in the NASDAQ as well. Any cracks, as I say, would probably trigger more bigger reversals than any upside surprise, because yeah, they punish for any downside disappointment and poor guidance. You can just see then Alphabet, Google stock, if you like, coming up to this 23.6 fib level. No, it's not the 23.6, sorry, it's 78.6. That's at, where is that? 194.57. That's interesting. Otherwise, then you've got that top from February at 208.70. Very strong bullish momentum. We are now overbought on the daily RSI as well. Otherwise, support 61.8 is at 183.47, and then you've got this sort of confluence of very strong support of the halfway point at 175. Also the 200-day moving average, that black line's at 175, and then the 50-day at 174. Okay, that's Google and Tesla and Q2 earnings. Let's move on then to just quickly a review of US CPI data from last week and UK data. First of all, the US inflation, kind of report had something for everyone. So the headline, that rose 0.3% in line with expectations, but up from the prior 0.1. That took the year on year to 2.7, above the 2.6 consensus, up from the 2.4. Core measures, though, they were softer. That is a big factor in this report, really. CPI, that rose 0.2%, matching forecasts, but accelerating from the 0.1 in May. Year on year, that came in at 2.9. Core slightly above the 2.8 prior, but below the consensus expectation of 3%. Markets were watching for any tariff impact, of course, and we got a 0.7% increase in core goods. That marked the fastest monthly rise in nearly 2 years, indicating some impact of levies, but then that was offset by the all-important shelter component. And we often say this, that is roughly 40% weighting in the core basket, shelter component. So a very critical factor to that metric. New vehicle and used vehicle prices also fell despite fears that that could be a source of inflation in the coming months, given big tariffs being applied to the sector. So all in then, yes, some tariff impact, of course. Potentially that will then feed into the core PCE number, the Fed's preferred inflation gauge, which potentially will rise to 0.35%, possibly 0.4 then rounded up, though that remains subject to other factors going forward. I think we get that data next week. Looking ahead, of course, many economists think price pressures could intensify in the coming months. Chair Powell has said that as well. He suggested that tariff-related price impacts could appear in August data, which would be due September 11, which is just ahead of the September 17 Fed meeting. That would be down, of course, those impacts down to inventory stockpiling ahead of course, tariff implementation. So yes, July, August, September data, really key to see whether we do get that tariff impact. It kind of all then supports the Fed's current wait and see stance, which allows for more data to come in before the next rate decision. Obviously, we get next week's Fed, but there is a very, very minimal chance of a Fed rate cut at that meeting, even though, of course, we've had two prominent members of the FOMC, Waller and Bowman, indicate a July rate cut could be appropriate, but they very much remain in the minority. Chair Powell, he has reiterated the Fed's willingness to act more swiftly if needed, but of course, we've seen a resilient labor market, pretty resilient economy as well, so there isn't really any urgency for any rate cuts now. And of course, you would think officials are still wary of the transitory sort of inflation call that they had post-pandemic, and really despite, of course, mounting political pressure from President Trump to lower rates, then the Fed need to just wait and see how the data pans out due to the tariff impact. Of course, we do have as well the August 1st deadline coming up, but again, deals are being announced, of course, Japan and potentially the EU, all eyes really on the EU, and then also China, although potentially their deadline later on in August may also be pushed back, with Treasury Secretary Bessent really talking about the quality of deal is what matters rather than the timekeeping, even though he sort of mentioned, I think, before that about August 1st being a pretty hard deadline. So generally markets thinking the TACO trade still is valid, and we do get some sort of tacit agreement deal, probably with little detail into that August 1st headline and then beyond that as well. Let's look at the dollar now. So the DXY chart, which I'll just grab here. Not a lot of change today, but we have had a few days selling, having tipped that, touched that blue line, the 50-a-day moving average, which has acted as resistance previously. So that's a good guide. That's a 98.48, and we're just rolling over now into the lows potentially. That 1st of July multi-year low, that's a 96.37. If I just pull this back for that dotted line, you can see a very long-term upward trend line from the May 2011 lows. Also tapped the cap to the downside, if you like, in June 2021, and then we had a big burst higher. So just watch out for this long-term trend line, that dotted line there. Otherwise, the multi-year low is at 96.37 in the DXY. Yeah, the dollar did have, if we just pull it back in, well, after that CPI data had its best day in a month, actually hit 3-week highs, but we sort of rolled over since then. The market was positioned really for a kind of dovish or a more dovish stance into the CPI data due to Trump's pressure, really, rather than any data or Fed Powell's obviously communication. We essentially then needed a really cooler than expected inflation print. We didn't really get that to sort of validate those dovish bets, and we got a decent push up in the dollar, but that has rolled over now as we come into that August 1st deadline essentially for tariffs. As I say, just a couple of basis points or so priced in then for the July meeting next week for the Fed. We are in the blackout period as well, so we don't really hear from Fed officials, although we heard from Chair Powell, but nothing on monetary policy yesterday. And there's around 16 basis points or so, maybe a touch higher then for the September meeting, so above a sort of around a 2 in 3 chance of a rate cut in September. Interesting then whether we do have that full impact from tariffs and inflation goes higher, and then correspondingly whether we get increased pressure and a ramp up in pressure from the administration, really, even though of course tariffs are potentially affecting inflation going higher. We shall see in the coming months. Otherwise, just quickly moving on from that, we did have UK data as well, quite important. CPI data that rose more than expected in the headline and the core. And the metrics, services metric, that stayed unchanged as well at 4.7% versus an expectation of cooling. Kind of kept elevated by backward-looking April road tax issues and rents, but they're set to dip sharply next spring because the services basket only resets once per year in April, but otherwise could be potentially sticky going forward. And of course, expectations into this data had been for potentially the Bank of England to cut quicker than its current sort of quarterly cadence pace, if you like, but headline and core inflation and services inflation sticky, so probably setting a pretty high bar really for faster rate cuts. Headline close to 4% really means inflation potentially could become entrenched as well. That will be on the minds of the MPC going forward at their August meeting. Jobs data as well we had last week briefly. We did see a big upward revision to the May payrolls data and also an upward surprise in wage growth as well. All points to not quicker, if you like, not quicker than quarterly rate cuts. So we probably still get a 25 basis point cut in August by the Bank of England, but we have seen a softening of expectations for rate cuts by year end, around 50 I think or so. So one in August and then one later on in the year, currently priced. For cable, interesting, it did find support at, well, a previous high from September last year, 134.34. and also then a minor fib level at 133.86. So we just bounced off that, and we're just trying to get above the blue line, the 50-day moving average, which has acted as support, so now is resistance. If we do break that, then potentially, yes, we're looking at that multi-year high, 137.84, from earlier in start of July, 1st of July. That was the print. Okay, moving on to this week's main events. Let me just pull up a couple of charts. Obviously, we have tomorrow the main event, ECB meeting, and also PMI data. Firstly, the ECB meeting, expectations are for the ECB to stand pat, so keep rates on hold at 2%. This follows on from, well, a June meeting where the Governing Council delivered another 25 basis point reduction in the depo rate, and actually was 8 straight rate cuts. So we're going to have a pause at this meeting tomorrow. Last time around, President Lagarde noted that policy was well positioned, I think she said, to navigate the current uncertainties, with the ECB at or near the end of its cutting cycle. Basically, the policy rate lies bang slap in the middle of the estimated neutral rate range of the ECB, which is 1 3/4 to 2.25%. So really now the current greatest source of uncertainty is the ongoing trade frictions between the EU and the US. Obviously, both sides trying to broker a deal ahead of that August 1st deadline. If they don't, then of course the US would impose actually now a 30% tariff on EU goods. And the EU, there's lots of stories about it potentially responding with its own countermeasures. Bluff and counter bluff sort of spring to mind, but hopefully something may happen before that August 1st deadline. All those fears, though, do weigh on the growth outlook, and allied, of course, with the rising euro that we've seen, appreciation in the single currency, they have stoked potential concerns around the ECB undershooting its 2% inflation target. Whether we get, or how much talk we get in the press conference or by the Governing Council around the euro will be interesting, of course, with its rise, and the issue around the inflation target going forward. Generally, reporting ahead of the meeting by the Governing Council suggested probably they are discussing a negative scenario tomorrow, than, well, previously envisaged in June after Trump's latest tariff threat. There may be talk, as I said, around the currency, but probably very little, and just that there's a lot of uncertainty, trade uncertainty, and that possibly I know that other ECB officials have, like de Guindos, have mentioned 120 as a line in the sand, but whether President Lagarde actually explicitly says that probably is quite unlikely. As it stands, markets, they're not really rushing to adjust expectations of ECB easing this year. One more rate cut is seen, fully priced by December, and really it's a sort of coin toss whether they cut in September or not. So interesting whether possibly Lagarde is slightly less hawkish than she has been. She's only been very mildly hawkish after that meeting last time around. So whether there is a sort of wait and see stance, meeting by meeting stance as well, probably is highlighted and emphasized. Just waiting to see what happens with the tariff deal agreement, and then potentially going forward a rate cut towards the end of the year. Let's just look at euro dollar now as well. Which is here, and you can just see this pickup from sort of support found around that April high. That was at 115.72. Didn't quite get to the blue line, which has capped to the downside previously. That's at 115.32. So decent bullish momentum now after sort of pausing for a while. Very strong, obviously long-term uptrend. You've got the multi-year high at 118.30. If we just pull this back a touch, you can just see that sort of corresponded with a bit of tracking sideways in August 2021. So 118.30, then possibly 119.09. Some resistance from previously in 2021. That is euro dollar. We do get PMIs as well. I should say they should reveal global evidence on, well, growth momentum, supply chain pressures, hiring appetite, and of course inflation risk as well. Australia and Japan, they kick off the readings, then France, Germany, Eurozone, followed by UK and US. Composite PMIs for virtually all those regions actually should signal modest growth, so a figure above 50. Of course, tariff headwinds loom large for the Eurozone PMI data, but manufacturing probably just below 50. Services did drop below 50 in May, but should pick up from 50.5 this time around. Then the composite is above 50 as well. For UK PMIs, services should tick higher, manufacturing rise as well, although that's still below 50. Of course, as some uncertainty has been removed with the signing of the UK-US trade deal, but then there has been now a pickup in uncertainty over domestic issues with, of course, growing speculation of tax rises in the autumn budget. Okay, I think we will wrap it up there. Don't see any questions at the moment, so hopefully that's all clear to you guys. I really do appreciate you being on the call, and take care out there. Lots of news going on. Obviously, these earnings later on today after the US close, and then the ECB meeting ahead of next week could be very busy as well. The Fed meeting, which we've touched upon, and also non-farm payrolls next Friday as well. Take care out there, and we will speak to you in a few weeks' time.